Welcome back to the Deep Dive. Today we're taking a journey back, really stepping into the history of something fundamental to modern markets.
Absolutely. We're looking at Charles Dow, the man often called the father of technical analysis.
And specifically the core ideas, the Dow theory that he pioneered. It's fascinating stuff.
It really is, especially when you think these ideas came about, late 19th century, before computers, before anything like the data we have now.
Right. And yet they still form a framework for how so many people understand market behavior. We've got quite a bit of material to dig into for this deep dive.
Yeah, we do. It covers his life, how the Dow Jones Industrial Average came to be, the actual birth of technical analysis as a concept, and crucially, those 6 tenets of the theory.
So our mission today, our goal, is really to unpack all of that, to understand the why behind these principles.
And, importantly, why they still matter, why they're relevant even now with all the technology and algorithmic trading buzzing around.
We want to peel back those layers for you.
Get right to the root of market analysis, sort of a direct line to the thinking that started it all.
Okay, before we jump right in, we have a quick request for you, our listeners. If you're finding these deep dives valuable, if they help you get informed quickly, maybe offer some surprising facts or insights.
Which we hope they do.
Exactly. Then please just take a second right now, hit that like button, share this deep dive with someone else who might find it interesting, and subscribe if you haven't already.
It genuinely makes a huge difference. Your support helps us keep these explorations going and reach more people. We really appreciate it.
Seriously, thank you. Okay, let's get into it. Charles Dow. Where do we start? Not with the theory itself, but the person.
Right, the man behind it all, Charles Henry Dow, born November 6, 1851. Sterling, Connecticut. Definitely not Wall Street.
Not at all. And the sources suggest that even from a young age, he had this real passion for storytelling and finding the truth in things.
Yeah, and communicating it clearly. That journalistic foundation is just so critical to understanding everything that followed. He started young, too, just 21.
At the Springfield Daily Republican, right? In Massachusetts.
That's it. Honing those core skills, observation, asking questions, structuring information so people could actually understand it, the basics of good reporting.
And he didn't stay put for long. Moved on to the Providence Journal in Rhode Island.
And this is where his focus really started to, narrow down. He began specializing in financial journalism.
Not just stock prices, though.
No, definitely not. It was about the why. Understanding the economic forces, the industries, the sentiment driving decisions, building that bigger picture of how the economy worked.
Which I guess made his next move kind of logical.
Almost inevitable, yeah. 1880, he moves to New York City, the absolute epicenter of finance back then. Wall Street was, chaotic, exciting, but definitely not transparent.
And it's there, working at the Kiernan Wall Street Financial News Bureau, that he meets Edward Jones.
A key encounter. The sources really emphasized they weren't just colleagues. They clicked. They saw the same problem.
Which was?
Information. Getting good, timely information was a massive challenge. It was slow, unreliable, fragmented. Think about banks, brokers. They were flying half blind sometimes.
Hard to imagine now with instant news feeds.
Totally. So Dow and Jones saw this huge bottleneck, and they decided to do something about it.
So 1882, they team up, bring in Charles Bergstresser as a silent partner with the money.
And Dow Jones and Company is born. Their first office was tiny, right near the stock exchange. And their big product, handwritten news bulletins.
Seriously, handwritten.
Yep, called flimsies. They'd write them up quickly, and runners would literally hand deliver them to subscribers, banks, brokerage houses right there on the street.
Man, that sounds so low tech. But I guess it was revolutionary then.
Absolutely. Getting news even minutes faster was a massive edge. These flimsies offered timely, curated financial intelligence. It was a game changer for decision making.
And the success of that service, proving the value of quick, reliable info, that's what led to the big one, right?
Exactly. Paved the way for the Wall Street Journal, launched in 1889, and Charles Dow. He was its first editor.
Taking the helm.
And the journal quickly became the source. Respected for unbiased, insightful reporting, market trends, company news, economic analysis.
And Dow used his own editorial column, like a testing ground.
Precisely. It was his platform to share his observations, his developing thoughts on how the market behaved. Those editorials were really where the seeds of the Dow theory were planted.
Having that direct line to a trusted publication must have been powerful. But he wasn't just an editor looking down from an ivory tower.
No, and this is a crucial piece the sources highlight. From 1885 to 1891, he was actually a partner in an NYSE member firm. Goodbody, Glynn, and Dow.
So he was in the market too, a broker.
Right. He wasn't just analyzing data, he was living the experience. He saw the trading mechanics firsthand, the order flow, how prices reacted instantly to news, but also to, emotion. Fear, greed, uncertainty, all playing out on the floor.
Wow. So you've got the journalist seeking truth, the publisher building a platform, and the market insiders seeing it happen, all in one person.
That unique blend is key. It fueled his curiosity, let him see connections others probably missed. He wasn't just looking at numbers, he was seeing the human element in the numbers.
Which really sets the stage for him noticing patterns.
Absolutely. His background wasn't just a resume, it was the perfect combination of experiences to identify and articulate these market dynamics.
And while all this was going on running the journal, being a broker, he also creates this thing that becomes almost synonymous with the market itself.
The Dow Jones Industrial Average. Yeah, he first cooked it up around 1884, initially just 11 companies.
Mostly railroads, I gather.
Yeah, they were the industrial giants back then. But the key thing wasn't what was in it so much as why he created it.
Which was?
To be a simple snapshot, a barometer of the market's overall health, and by extension, the health of the U.S. economy. He picked companies representing key sectors to reflect broader trends.
And look at it now. Still one of the most recognized indices in the world, a daily headline.
Its legacy is incredible. So you see, the journalism, the brokerage, the journal, the DJIA, they weren't separate things. They were all part of this single driving quest to understand and explain the financial world.
That deep immersion, both observing and participating, that's what laid the groundwork for the theory.
Exactly. It wasn't abstract. It was born from the reality of Wall Street.
Which leads us right into the birth of technical analysis itself. It wasn't some academic exercise initially.
Not at all. It was a practical outcome of everything we just discussed. Being right there, seeing the market move, reporting on it, trading in it, he started seeing patterns, recurring patterns in stock prices.
And these weren't just random squiggles on a chart.
No, he noticed they seemed to connect with broader economic shifts and also with, investor psychology. This led him to a core belief, really the cornerstone of all technical analysis.
That the market price reflects everything.
Everything known, yes. All the economic data, political news, company earnings, investor sentiment, hopes, fears, it's all baked into the price you see right now. The market absorbs and processes it all.
That's a powerful idea. And it was a really different way of looking at things back then, wasn't it?
Oh, completely. The main approach was fundamental analysis. Digging into balance sheets, income statements, economic indicators, trying to find a stock's true value.
Which takes time and expertise.
Right. Dow shifted the focus. He argued, essentially, if the price already reflects all that known stuff, then studying the price action itself and the volume that goes with it gives you the most direct insight.
So the chart becomes the summary of everything.
Precisely. Why try to second-guess all the fundamentals when you can watch how the market is reacting to them in real time, through price and volume? It was revolutionary because it suggested analysis could be more immediate, maybe even more accessible.
Makes sense. And he used his editorials in the Wall Street Journal to share this.
He did. Between 1900 and 1902, he wrote about 255 of them. That's where he really articulated his observations. He used analogies like comparing market movements to ocean waves, tides, waves, ripples, to help people visualize these layers of trends.
So those editorials were the raw material for the Dow Theory.
They were the foundation. But it's a really crucial point. Dow himself never called it Dow Theory. He never laid it out as a formal system, like step 1, step 2. He was sharing insights, a way of thinking.
And unfortunately, he didn't get to finish that work.
No, sadly, he passed away December 4th, 1902, before he could really consolidate it all into one big piece.
But the ideas didn't die with him.
Thankfully, no. They were picked up, preserved, and actually expanded upon by people who worked with him or were inspired by him. Guys like William Peter Hamilton, who took over his column.
And later, Robert Rhea and E. George Schaefer.
Exactly. They were the ones who studied Dow's writings meticulously, analyzed them, distilled the core concepts, and organized them into the structured framework we know today, those 6 principles.
So they formalized it, really cemented it as the bedrock of technical analysis.
That's right. It was their work that turned Dow's observations into the foundational theory. It was a huge shift in how people thought about analyzing markets.
Okay, so let's dive into that bedrock. The 6 tenets of Dow theory. These are the core principles, right? Derived from those editorials, refined by his successors.
And still incredibly relevant. The first one, the market has 3 trends. What did Dow mean by that?
He saw market movements weren't just random noise. They happened in distinct trends based on time.
Exactly. He broke it down. First, the most important one, the primary trend. This is the big one, the long-term direction. Think months, usually years. It's the overall bull market rise or bear market decline. Capturing this is key for long-term players.
That's the main current. What else?
Then you have the secondary trend. This is intermediate term. It moves against the primary trend. Think corrections in a bull market or rallies in a bear market.
How long do these typically last?
Generally 3 weeks to maybe several months. They can retrace a good chunk, maybe a third, maybe 2/3 of the previous primary move. They're like the market catching its breath, or sentiment shifting temporarily.
So if the market's climbing steadily long-term, a secondary trend is a significant dip before it potentially continues up.
Precisely. A necessary pullback. And finally, the minor trend. These are the short-term wiggles, daily fluctuations, maybe lasting a few hours up to a couple of weeks. Dow Theory basically says these are noise.
Just market static, not really important for the bigger picture.
Largely, yes. The ocean analogy works well here. Primary trend is the tide. Secondary trends are the big waves within the tide. Minor trends, just the little ripples on top. For serious analysis, Dow suggested focusing on the primary and secondary, ignore the minor stuff mostly.
Got it. Okay, tenet number 2. Trends have 3 phases. This describes what happens within a primary trend, correct?
That's exactly right. Dow noticed primary trends unfold in stages, reflecting shifts in psychology and participation. The first phase is accumulation.
Accumulation.
Yeah.
A key concept, especially for what we do at AccumulationPro.
Absolutely. In this phase, the really informed investors, the smart money as they're often called, start quietly buying. This usually happens late in a bear market or after a big drop.
When everyone else is pessimistic.
Exactly. News is bad, sentiment is awful, prices look cheap to those who see the long-term value. They start accumulating shares, buying from those who are panicking or giving up, but they do it subtly without causing big price spikes.
So it's the quiet gathering of shares before the storm.
Pretty much. Low public interest, lots of skepticism. Then comes phase 2, the public participation phase. This is where the trend becomes obvious.
The herd starts noticing.
Right. The news starts getting better, maybe economic numbers improve, prices begin a clear, sustained rise. The general investing public, retail traders, trend followers, they see it happening and jump in.
And that fuels the fire.
It adds momentum, drives prices much higher. This is usually the longest phase and where the biggest gains happen in a bull market. Optimism grows, turns into enthusiasm. It's easier to join now, but the risk is also increasing.
Because you might be late to the party, which leads to the third phase.
The distribution phase.
Yeah.
This is the mirror image of accumulation. Market euphoria is peaking, everyone's convinced stocks only go up.
And this is when the smart money starts selling.
Exactly. Those savvy investors who got in early during accumulation start quietly selling their shares, distributing them to the eager latecomers who are piling in at the top.
So selling into strength.
Yes. You might see momentum slowing, maybe more volatility, even as prices make maybe marginal new highs. Supply starts to overwhelm demand from the late buyers. It signals the party might be ending, that the primary trend could be reversing. Understanding these phases, accumulation, public participation, distribution, gives you a map for market cycles.
That's incredibly useful for context, knowing where you might be in the bigger picture.
It's timeless, really. It's about crowd psychology.
We're really getting into the foundational elements here, the absolute basics of how technical analysis started. If you, listening, are finding this useful, if it's giving you a new perspective,
We'd really appreciate your support.
yeah, please take a quick second like this deep dive, share it with someone you think needs to hear this, and definitely subscribe so you don't miss future explorations.
Every click helps us keep digging deep into topics like this for you, so thank you again.
Okay, back to the tenets. Number 3. This might be the most famous one. The market discounts everything.
Yeah.
Huge concept.
It really is the philosophical core of technical analysis. Dow's belief was simple but profound. The current price reflects all available information.
Everything, like earnings, economic data, political news.
All of that, yes, but also the intangible stuff. Industry trends, competitor actions, investor hopes, fears, biases, the collective psychology. The market processes all this constantly, and it's reflected in the price.
So the price chart isn't just history, it's like a live summary of the market's collective brain.
That's a great way to put it. And think about the implication for an analyst. If the price already reflects everything, you don't necessarily need to be an expert on everything. You can focus on analyzing the price action itself because that's the end result of all those inputs.
You're analyzing the reaction, not just the news.
Exactly. Now, obviously today, information moves instantly, algorithms react in microseconds, but the principle holds the price is where all that information meets reality. It just happens much, much faster now.
Right. Okay, tenet 4. The averages must confirm. What's this about?
This goes back to the indices Dow created. He argued that for a major primary trend to be truly valid, it needed confirmation from both the Dow Jones Industrial Average and the Dow Jones Transportation Average, which originally was the railroad average.
Why both? Why did they need to agree?
It was about economic logic.
Yeah.
If industrial companies, the DJIA, are making more stuff, then the companies that move that stuff, the DJIA railroads, should also be doing well. They're interconnected.
Makes sense. Production needs transportation.
Right. So if the industrials are hitting new highs, but the transports aren't keeping pace, maybe even falling, that's a warning sign. Dow saw it as a divergence, suggesting underlying weakness. Maybe those goods aren't actually being shipped or sold, indicating a potential problem the industrials alone don't show yet.
So a lack of confirmation was like a yellow flag for the trend.
A big one, yeah. He'd be very skeptical of a bull market if the transports weren't confirming the industrials' rise. It suggested the economic expansion wasn't broad-based or sustainable. While the specific averages and economy have changed hugely, the principle of looking for confirmation across related sectors or indices is still a valuable analytical technique today.
Okay. Tenet number 5. Volume must confirm the trend. Where does trading activity fit in?
Volume is critical. It's like the fuel behind the price move. The basic idea is volume should increase in the direction of the prevailing trend.
Can you break that down?
Sure. In a healthy uptrend, you want to see higher volume on days when prices rise and lower volume on days when prices pull back. High volume on up days shows strong buying interest, conviction, broad participation.
And the opposite for downtrends.
Exactly. In a confirmed downtrend, you'd expect higher volume on down days, showing strong selling pressure, and lower volume on bounces or rallies.
So if a market is rising, but the volume is drying up, that's a red flag.
It suggests the move lacks conviction, yeah. Maybe it's just a lack of sellers rather than aggressive buying. It makes the trend more vulnerable. Volume helps you gauge the quality or strength of a trend, distinguishing real moves from weak ones or false signals. Analyzing volume is more complex now with dark pools and algos, but the core idea, strong moves need strong participation, still matters.
Got it. And the final one, number 6. Trends persist until reversal. Sounds simple, but what's the takeaway?
The takeaway is all about discipline. Once a trend is established and confirmed, assume it will continue. Don't fight it. Don't try to pick the exact top or bottom.
Ride the wave until it clearly breaks.
That's the idea. Stay with the trend until you see clear, objective evidence that it's reversing. For an uptrend, that might mean the averages start making lower highs and lower lows, or secondary corrections become much deeper, or volume patterns shift negatively. For a bear market, you look for signs of accumulation and higher high slows.
Avoid trying to be a hero and call the turn too early.
Exactly.
Right.
Which leads to that famous quote often attributed to Dow.
About pride of opinion?
Yeah, something like, "Pride of opinion has been responsible for the downfall of more men on Wall Street than any other factor. It's a reminder to stay humble, follow the market's signals, and don't let your ego or your predictions override what the price and volume are actually telling you. Discipline over prediction."
These 6 tenets, taken together, they really form a coherent, logical system for looking at markets.
They provide structure, a way to read the story the market is telling, cutting through the day-to-day noise.
So let's think about why Dow developed this. What was driving him?
Fundamentally, I think it was a desire to make sense of it all, to bring some kind of order to what looked like chaos. His journalist background meant he wanted to understand and explain. He saw Wall Street was intimidating, confusing for most people.
He wanted to democratize understanding, in a way.
I think so, to give people tools beyond just rumor or hype. And his time as a broker showed him firsthand how emotions, fear, greed drove bad decisions. He saw price movements weren't random, they were linked to economics and human behavior.
His editorials were exploring that link.
They were analytical pieces digging into that interplay. The ocean analogy was brilliant because it helped visualize the market not just as a line, but as this dynamic system with different forces, the tide, the waves, the ripples.
And he saw the need for something more than just description, something predictive.
Definitely. Because relying only on fundamental data often meant you were looking backward. By the time news was out and digested, The market had often already reacted.
Because the market discounts everything.
Right. So he focused on price and volume as more immediate indicators. He wanted to give investors a framework to navigate volatility, to anticipate moves based on observable patterns, not just old news.
And the averages, the DJIA and transports, were crucial tools for that.
They were his benchmarks. He used them to test his ideas, to validate trends, to look for that confirmation. They provided a concrete way for people to apply his theory and gauge market health. He was building a practical toolkit for a very different financial world.
It's amazing how that core quest, understanding the market, providing tools, still resonates so strongly.
It really does, and that's where we see the link to modern approaches, like we've touched on. The source material explicitly connects Dow's foundational ideas to today's data-driven strategies.
Even with supercomputers and AI trading, the roots go back to Dow.
The core principles, absolutely. Modern platforms, think about AccumulationPro, for instance, essentially take Dow's concepts. Price reflects information, trends exist, and especially that crucial accumulation phase where sophisticated players get involved.
They take those ideas and apply modern tech to them.
Exactly. Algorithms sift through massive data sets looking for patterns that align with that early accumulation, the subtle footprints of informed money positioning itself before the main trend kicks off.
It's like having a high-tech way to spot what Dow spotted through careful observation.
Precisely. These systems are designed to follow those sophisticated market movements, identifying those shifts in supply and demand that signal professional interest. And, very importantly, they build in robust risk management.
Which also connects back to Dow's discipline.
Right.
Waiting for confirmation, following the trend.
Yes. Dow Theory encourages a risk-aware approach. Modern systems take that much further, integrating strict risk controls, position sizing, stop losses, all aimed at navigating volatility and achieving more consistent results over the long run.
So it's identifying opportunities based on those Dow-like patterns, but also rigorously managing the downside.
That combination is key. It's applying the precision and power of modern data analysis to those timeless market observations. If you're serious about trading and want a structured, data-driven approach that builds on these proven principles,
then exploring platforms that operationalize these concepts makes a lot of sense.
It's moving beyond guesswork.
Absolutely. And to see how cutting-edge algorithms identify and track sophisticated market movements, all while emphasizing risk management for long-term success principles, really rooted in Dow's work, you should definitely check out AccumulationPro.com.
It's a prime example of Dow's wisdom meeting modern execution, identifying those early moves and managing risk effectively.
When you step back, Charles Dow's impact is just immense. The DJIA, still a global benchmark. The Wall Street Journal, still a leading financial voice.
And the Dow Theory itself, the absolute foundation of technical analysis. Whether you're drawing trend lines by hand or using complex algorithms, those core ideas are embedded everywhere. Markets move in trends, price reflects info, volume gives conviction, trends persist.
You still hear critics, though. The market's too fast now, it's all algos, derivatives changed everything. Can 19th century ideas really still apply?
And it's a fair question. The environment is vastly different. But the underlying dynamics Dow identified, crowd psychology, the cycles of fear and greed, how these manifest in price patterns, those are remarkably constant because human nature hasn't fundamentally changed. The theory's focus on observable price and volume keeps it relevant as an anchor.
It provides that essential framework.
Exactly. For any trader, understanding these tenets offers a structured way to approach the market, identify opportunities, and crucially manage risk by recognizing the phases of a trend.
Knowing this history, this theory, it deepens your understanding, helps you make more informed decisions.
Definitely. It gives you context for the patterns you see on the screen every day.
So, wrapping up this deep dive, Dow's journey was incredible. Journalist to financial visionary.
His power of observation, his innovation, it transformed market analysis, giving investors tools to understand trends, to see price as information that was huge.
And incredibly, those tools, those core principles, remain a guiding light even as markets evolve.
They provide that foundational understanding, valuable for everyone from novices to seasoned pros. It enhances your ability to read the market story.
Absolutely. And again, if you want to see how these foundational insights are applied using today's technology, focusing on identifying sophisticated plays and managing risk,
take a look at AccumulationPro.com. See how data-driven algorithms build on the very principles Dow pioneered.
It really connects the history to modern practice. Okay, one final thought for you to chew on as we finish up.
Go for it.
Given Dow's tenet that the market discounts everything, and knowing how incredibly fast information travels and is processed today. What does that acceleration tell us about market cycles themselves? Are they faster, shorter, more volatile compared to Dow's era?
Interesting question.
And maybe more importantly, even with that speed, how does understanding those fundamental phases, accumulation, public participation, distribution, still give you an edge? How does it help you keep your head, avoid the FOMO or the panic when the charts are moving faster than ever?
Because the underlying human behavior driving those phases is still there, right? Even if it plays out quicker. That's a great point to ponder.
Something to think about. We really hope this exploration of Charles Dow and the Dow Theory was insightful for you, if you found value here.
Please, one last time, take that quick moment to like, share, and subscribe. It truly helps us continue bringing you these deep dives.
Your support means everything. Thank you so much for joining us today.
It's been a pleasure diving into these foundational ideas with you. Thanks for listening.
Thanks, everyone. Have a great day.